A-list stocks. We have two of our colleagues joining us now to give us the stocks that they've picked out today. First up, Mangalam, what are you looking at?
Well, on my A list today is so Z Entertainment makes my A list today, and there is a lot of positives going for the company. In fact, the first positive is the fact that its flagship channel Z TV is among the leading Hindi general entertainment channels. Also, they have 33 domestic channels, and they have presence in all the other genres like movies, music, sports, entertainment, and international channels as well. And what also is the key for them is their strong presence in the regional markets. They have channels in languages as diverse as Marathi, Kannada, Bangla, Telugu, and even last quarter they acquired an Odia company. So they have all these things going for them, plus a strong content library which will give them ammunition going forward in the digital world as well. So what have they done earlier? In the last 3 years, their top line has grown at a CAGR of 17.1% to end at around 4,883 crores in FY15. If we break that up, 19% of that top line growth or the ad growth has come at a CAGR of 19%. Also, subscription revenues have grown at around 11% in the last 3 years. If you look at the bottom line has grown at 18.5% in the last 3 years to end at around 980 crores in FY15. But the FY15 ROE, return on equity and return on capital employed, is what we have to look at as well, because the ROE ended at around 19% and the return on capital employed is close to 23%. What has changed? In Q1 FY16, the ad revenue actually jumped up to 25.5% with the addition of new channels, and when we spoke to the management, they indicated that ad revenue will now sustain at 25%, which is a good 4 percentage points higher than their last 3-year ad revenue growth. Now, if you look at their balance sheet as well, their long-term debt on their balance sheet stands at just 1.2 crores, and the short-term liabilities are 500 crores, but they have trade payables of 420 crores, but against which they have receivables of close to 1100 crores, and they have a cash of close to 740 crores. As far as their interest costs are concerned, they're very well covered, because for every 1 rupee interest that they pay, they do actually generate about 110 rupees in earnings before interest and tax.
That's free cash for you. But, you know, the stock has also risen from what, 280 a year ago to 370 now. Is all this in the price? Are we paying a lot for it?
Actually, not paying a lot for it is what the analysts estimate, because the stock at current levels trades at around 29 times FY17 earnings, which is slightly higher than its historical long-term valuations of around 24, 25 times. But this premium, analysts believe, is on account of increased investments by the channel on building and acquiring new channels for the future. Direct comparables of this channel are very few, but if we were to, you know, if we were put a gun against our shoulder and asked to compare, if we compare it to Sun TV trades at 16 times FY17 earnings, but that's because of its own problems as well. But at these valuations, the future growth kickers is what analysts believe are going to be in the price, because if you look at it, subscription revenues might grow going forward. Looking at phase 3 and 4 digitization, then new channels Zindagi and TV will add to their ad revenues. Also, they've started a new over-the-top OTT platform called Ditto TV, which will work or add generate additional revenues as far as the digital world is concerned. And India's ad to GDP ratio is lower as compared to the world. So with growing economy, the ads are only likely to grow. So that's why Z makes it to my A list.
All right, Mangalam, thanks for that. Well, the other stock is that Varinder has picked out is AIA Engineering. Varinder, tell us about this stock. You know, it's given a lot of returns to investors in the last 2 years. It's moved from 300 to 900. But what could be the fresh triggers?
Well, we have literally covered A to Z of A list today. You know, Mangalam starting with Z and I starting with A. You know, just for the beginners, AIA Engineering is the second largest high chrome casting producer in the world. So, you know, it has a niche of its own. In a simple terms, it manufactures mill internal products which are used by the cement, mining and utility industries. Imagine this company has nearly 90% of domestic cement market, 70% of thermal utility sector. So it's the largest, if you have to consider, in any space in what it operates. Now, the reason why I really picked up the stock is the stock is trading around 930. It has corrected from 1,360. That means the stock has corrected nearly 35% from 52-week high. The stock corrected on concerns of, you know, post-commodity meltdown, you know, that may impact volumes going ahead. Remember, this company came with an IPO in 2005 at 315 rupees. In 2006, they did a QIP at 1,225. There was a stock split which was done from face value 10 to 2. That means if you have to just literally see, the stock has actually moved from what 300 or something to 4500 in the last 9-10 years, and there is no dilution done by the company, which is one important parameter which I personally look at in the last 10 years. So this company hasn't done any dilution at all. Now look at this, okay, the balance sheet. It's a net cash balance company with 715 crores which are lying on the books of the company. Long-term debt only 55 crores, current investment of nearly 630 crores, cash balance of 187 crores. Come to revenue now, which is the important picture. If you just see the revenue, just see the last 4 years, you will see in the last 4 years there is a CAGR growth of 22.2%. If you have to look at last 4 years, from 1350 crores, the company has managed to grow revenue to as high as 2100 crores. Look at the EBITDA growth in the last 4 years. 32% growth in terms of EBITDA. From 286, the company has went to as high as nearly 668 in the last 4 years. Look at the margins for the last 4 years. From 21%, the margins have moved up to 31% in the last 4 years.
Okay, I'm just trying to play devil's advocate here, Varinder. In terms of the growth so far, it's been very good. But in the quarter gone by, the management had indicated some slowdown in the mining segment.
Sure, I'll come to that.
So would that worry you?
No, I'll come to that because that is also important. But just small numbers here. If you look at the PAT also, the PAT has grown from 181 crores to 431 crores in the last 4 years. Thus means a CAGR of nearly 33.7%. Now, in one parameter which Lata told to include particularly was ROE and ROCE. Look at the ROE for this company for the last 4 years. From 16.8%, it went to 23.8% in FY14 and 28% in FY15. Look at ROCE. ROCE from 21%, FY12 and 12-13, it went to 30%. The company has consistently done well in the last 4 years put together on an annualized basis.
Okay. Now her question, will it do well?
No, because I was just concerned about the mining segment, because in the quarter gone by, the mining volumes had fallen about 12%. Is that something that could have restricted the upside?
You're absolutely right, Sonia. 31% EBITDA margin growth in FY15, it came down to 27% in quarter 1. The volumes on a consolidated basis were down by 7%. This is what happened, but the management has maintained their guidance. As I said, the reason why I picked up the stock is because the stock has corrected 35% from that all-time high what it hit. If you look at the valuations, current valuation 920, look at this, okay, the FY15 EPS for this company was 46 rupees. I have taken the most conservative EPS on the street. FY16 EPS is expected to be 52 rupees. FY17 EPS is expected to be 57 rupees. A growth of merely 8 to 9% in the next 2 years. On 57, if the company does 57 rupees in the next 2 years, it's trading at 15-16 times on FY17 basis. Which, if you have to see historical valuation, it was trading at 25 to 28 times because of after the correction. Look at these, okay, some of the key positives or the visibility for this company. The volume guidance stands at 80% CAGR for the company. Most important last point is that if you just look at this company, they don't have to put any additional money on the capex.
Okay, so
they have already lined up that in 3rd quarter, 4th quarter there will be manufacturing units which will be coming up. There's a lot of cash which is lying on their books. They don't have to take any debt or equity going ahead. So volumes will be coming in. Of course, the growth may not be same what had happened in the last few years, but the consistency will be there, maybe at a slower pace.
Fair point. Thank you very much. Several last final points there which are extremely positive for the stock. Thank you very much for covering the stocks A to Z, Varinder and Mangalam. Okay, let's